Okay, so...
Thanks. Good afternoon. It's Jared Castle from UBS. Two, if I may. You've kind of identified the UK market as it currently stands at 682,000 rooms. Do you have any view in terms of where it would go to by 2018? And then second question, I don't know if we're going to spend a bit more time on this, but just on Hub, it seems like you're quite confident there won't be cannibalization from the current Premier Inn product. Can you just expand a little bit on why you view that will be the case? Thanks.
Let me answer the second question first by saying we do have a presentation on Hub, so let's try and readdress that question once you've heard it, because it is something that's very much in our minds, and we do have an answer to it, which hopefully you'll hear later. Patrick, do you want to talk about life beyond 2018?
Yeah, I think we talk in the actual slide on slide 39. We actually give an overview of what we think the hotel market will be like in 2018. Go up to 700,000 rooms with branded share increasing to 54%.
In essence, our plans for Premier have been based very much on share gain. We think we've got a superior product, and we believe there's all these structural changes taking place in the market. So we haven't factored in any growth in the market. Your guess is as good as mine as to when we'll see any significant sustained improvement in the UK economy and its growth in GDP, which tends to drive demand growth in the hotel market. If it happens, it will be nice to have the tide behind us for once, but we don't need it.
Yeah, hi, it's Vicky Lee from Barclays. Just a couple of questions. You talked about potentially thinking about Premier Inn outside of the UK and continental Europe. Just keen to know which kind of markets you're thinking about and what format that would be. Would that be sort of asset heavy at the outset and then asset light afterwards? And then just coming back on slide 27, you were talking about the EBITDA margin and some of the offsetting some of the issues around the lease mix, etc. Just, I suppose, a little bit more colour on how we should really think about that EBITDA margin going forward and how much that offset will be.
So, Nicholas, if you do the second one. But in terms of Europe, let me just make a couple of contextual points first, which are quite important. The first one is, as we've said before, innovation and testing is a critical theme throughout the whole of Whitbread. The second thing to say is we've made no decisions. What we're simply saying is that we're considering testing in continental Europe. The markets that look most interesting at the moment are Germany and the Low Countries. Why? Simply because they're large hotel markets. The balance of construction and land cost and RevPAR looks sensible. They've got normal institutional land markets. They've also got relatively low penetration of budget brands. They've got large independent sectors which are showing some signs of moving away. And the sort of testing that we're doing at the back of our minds, or we're thinking of doing, is that it would be an extension of the UK model, really quite distinct from the business approach that we're taking in the emerging markets, where there's no established competition. The market for land is really quite different. Access to land is quite different. The risks are quite different. But just to come back, we are just considering testing. And to be quite honest, there's the sort of thing we wouldn't mention normally if we didn't happen to have you all here today for an Investor Day.
So the question was about the EBIT margin and how should we look at it, kind of given we are going to continue to grow in leases. It's interesting. I mean, EBIT is just one way we look at it. Actually, we look at it. You've got to look at it more down at the PBT line because you have a choice. You either lease or you take a freehold, and the freehold will go through your debt, which will change your interest line. And you look at our interest line over the last few years. Actually, it's been fairly flat. Actually, in terms of that. Actually, so you've got to take those both into account. So looking at it, EBIT is a bit kind of one-sided. Having said that, you've seen it's come down over the last 3 years, as I pointed out. And that's, again, because the rent's going in. It came down also last year, as I said, because we invested in our central overheads, particularly around digital and dynamic pricing and the restaurant team. Going forwards, what will happen is you'll see that although the rent will continue to increase as you do more leases, you'll get more maturity of the leasehold portfolio. About 40% of the leaseholds are under 5 years old, so they're quite immature, our portfolio. So they'll get maturing of that, which will go in your favour, and also you'll start to leverage those central overheads as we grow, because last year was a one-off where we invested back in again, and we'll be starting to leverage those. So I think over the very short term, you'll still see the margin come down slightly, but then going forward, you should start seeing that being very, very minor. Okay.
Some more questions down here at the front, Lynn.
Thanks. Jamie Rollo from Morgan Stanley. A few questions, please. First of all, you've helpfully given us the EBITDA per room in central London. What's the differential in the rest of London, which I think is about sort of 3/4 of the London rooms? Secondly, I think you mentioned £10 million of cost savings. Is that after this year, or is it based on the 2013 sort of base? I mean, are marketing and other costs going to go up this year by 10, in other words? And then finally, is there any sign of sort of CapEx creep or amenity creep in the industry? Everyone's got new beds and so on. Are you worried about that at all? Thank you.
Patrick, why don't you talk about amenity creep, and Nicholas, maybe the other two.
No, we're going to talk to you later on about our new bedroom product, both our new bedroom product and our new mattress and the new room design. And I think when I talked about that, you'll see that we're looking to try and do that at a cost-neutral position. Mark's already talked about how we're trying to drive down our construction costs. So we're very conscious of that. We don't want to add lots and lots of more cost to the business.
And in terms of, I mean, the reason to focus on central London, because that's one of the big parts of growth. So we're trying to help you kind of think forward about the growth. So we haven't disclosed what the kind of rest of London looks like, but it's actually somewhere probably in between the two of them, actually, to be fair. Probably a little bit towards more the regional than the central London one at the moment. It very much depends where you are in those London sites as well.
Cost savings?
Overall. In terms of the cost savings, we invested last year. You get a little bit of annualisation of that coming through this year. And then going forwards, it's about taking 10 million of gross costs out over those 3 to 4 years going forwards as well. But it is gross costs.
Thanks. Lena Thacker from HSBC. Firstly, on the co-located sites, as you showed us, the returns are significantly below the other models. Do you have any plans there, perhaps, in terms of trying to acquire those third-party pubs or pub restaurants, sorry. And then secondly, if we take your 500 micro sites, I wonder if you could tell us, once you get to your 75,000 rooms, how many of those will still remain as virgin catchment areas? And if you can, how many of those would be areas where you could add more capacity, where you have existing, and how many would be saturated? That would be helpful. Thank you.
Yeah, I mean, the answer on the colos is quite simple. No. They're very much a product of our history and the way in which the business has been put together. So we might do the odd new colo in very special circumstances, but what we've got, as you can see, makes an okay return, and I think we'll just leave it as that. Simon, where is Simon? The 500 micro markets, do you happen to have an answer to that?
I'm afraid I don't actually have the specific statistic. Yeah. I think there's one small point to make, which is it's not just a virgin catchment, it's also our penetration within that catchment. Yeah. As we alluded to with the Edinburgh example, there's a number of catchments where we are under-penetrated, and we have good evidence that we can still add capacity and drive RevPAR in those markets.
Okay. There's another question just next door. Yeah.
Hi there, Tim Barrett, Nomura. Just sticking with the colo issue, that 12.6% return, have you tested whether that is structural in the business model, or whether you're just perhaps unlucky with the pub next door or the location, the micro market? And then a second question in terms of on property, really, the site competition. Are you experiencing a different pricing environment now Travelodge has scaled back its growth? Thank you.
Patrick, since I failed on colo first time round, do you want to try and answer it again?
No, I think colo was mostly born out of the Spirit piece we bought. So, we had that cost when we came into it. It's worked well for us. It's just that we don't get all the joint site synergies around it. So we don't get a sharing of labour at site level. We don't really have that same output. Some colos in certain parts are very good. Some of them are quite small. Some of them down to sort of 18 to 20 bedrooms. So that's one of the other things we have behind that.
The other thing you'll hear later is the guest journey, the customer satisfaction is significantly lower, and that has an impact on RevPAR. Mark, do you want competition?
Yes, on competition. Well, Travelodge aren't the only competitor for new sites, so it has been beneficial for us that they haven't been as active or as aggressive as they could have been in the last couple of years. And actually, we've been successful in taking a number of their sites, probably about 1,000 rooms that were in their committed pipeline, and making them Premier Inns, and we're going to build those over the next couple of years. But we're competing with a wide range of other users, hotel people, student accommodation, offices, residential, but we're continuing to have great success and to outcompete for the right sites for us.
There's one at the back there.
Thanks. Good afternoon. Tim Ramskill from Credit Suisse. Two questions. One, when you talked about a preference for freeholds, you talked about the ability to lock in development profits. Could you just give us maybe some sense as to the advantage you do gain from a value creation point of view when you do take on a freehold and develop that from scratch relative to the developer gaining those? And then the second question was, I guess for a couple of years now you've very much put in the shop window your growth plans over the next 5 years. But equally, back in sort of 2009, the business really did pull back quite sharply on growth plans. What set of circumstances would it need for you to, in any way, step away from your 75,000 UK target?
Okay, let me answer the second one, and then maybe, Nicholas, if you can help on development profit. The thing, as we've said many, many times, is we're hugely focused on return on capital, and that is specifically incremental return on capital. So as we open new sites, we are looking very carefully at, are we delivering the return that we need? And as we've said, we're looking to maintain our economic return on capital. And what that means is making an adjustment for whether it's a leasehold or a freehold. As we open new sites, we're pretty good at building them to budget, and we know more or less exactly how much it costs to run new sites. So the critical variable is RevPAR. And as Mark said, we go through a quarterly review of all of the new investments that we've made, usually over the last 4 years, and we look very much at what's happening to RevPAR. Are those hotels on the right maturity curve? As soon as we feel that the return on incremental capital is starting to drop, that's the main warning sign that will say we will slow up our investment. Now, what the reason for that might be, who knows? It could be something to do with the business model, it could be something to do with our selection decision, or it could be some wider macroeconomic factor. Who knows? But we're looking at that very much as the critical forward-looking KPI in, if like, our financial dashboard.
Yeah, so just in terms of the freehold, we've done a number of sale leasebacks over the last few years. So the one we did last year, we had proceeds of 50 million and we made 20 million pounds profit on that. Of course, it depends how old the site is, and depends when you bought in what the net book value was.
Nigel Hicks from Agency Partners. Can you just say what sort of capitalisation multiple you use when your returns for leasehold units? And also, just on RevPAR growth, are you going to increasingly split out London and regions, just because obviously the higher mix of London pushes your total absolute and like-for-like RevPAR numbers higher? Just
in terms of RevPAR growth, I mean, we are very much in the habit of reporting London and the regions. That's the way in which people do it. We're conscious that as we look at London, there is a mix effect as we grow faster in central London. I'm not sure whether we will split it out anymore simply for competitive reasons. Multiples?
Yeah, there's two reasons to look at your multiples, not in your leases but your freeholds. One is to making sure you're making a leasehold versus a freehold decision correctly, and the other is to look at what your level of liability risk is in the business. When we look at the leasehold, you're trying to equate the leasehold to a freehold to make that right decision. And for hotels and restaurants, we take quite a punitive view on that to make sure we capture the advantages I discussed about the advantage of freehold, but also to incentivise the property teams to look at the freehold options as well. It also depends on the kind of length of the lease as well. But if you take an example, if you take a 25-year lease and you think about what a kind of proxy for debt of 5.5% is, you discount that back, you get to about a 14.5 times. It's obviously a lot shorter for Costa though, because they've got shorter leases. But it's kind of equally as important to look at it from kind of how you manage your liability management as well. And that's much more about what's our forward commitment. And you can look in our accounts, in one of our notes of accounts, it tells you what our forward commitment. You discount that back. You take account of the shorter break clauses as well. And you look at more about 8 times. Yeah.
There's another question down here on the front row.
Hi, good afternoon. Komal Dhillon from JP Morgan. Just a question again on the leasehold and freehold. Could you give us an indication of what the split is within London versus the regions, and if you can, Central London versus Greater London? And then also more specifically on the new format, the hub format, can we assume that that's mainly going to be leaseholds given that it's in such central locations?
Yeah, I mean, in central London, we do actually more opportunities. I mean, some of the ones that Mark showed you up there on the slide actually are freeholds. So we are seeing more freehold, but the majority of central London will be leasehold.
I mean, freehold in London is a little bit potluck. We like to do freehold, but it's very much situation dependent. And it just so happens that 2 of the, I think it's 2, if not 3, 3 of the hub sites that we highlighted yesterday are freehold. I think that's unusual, and it just happens to be where those sites are. But generally, it's hard work to get freehold in London. Yeah, Jamie? Yeah.
So just one quick follow-up. Back to that central London profit per room figure, is that adjusting for the county hall? I think it's quite an attractive arrangement you've got there because of legacy reasons. Does that adjust for that very profitable unit? Or
In the example we gave here, Central London, that's an indicative of our pipeline, not historical. And it's before central overheads as well.
And County Hall's not terribly unusual, in the sense that the new site that we've opened nearby is performing very well too.
One last question, these are for leaseholds. That's a freehold, yeah, long leasehold.
Time for one last question before we have a break. There's over there, yeah.
It's Sam Hart from Charles Stanley. I was wondering if you could just update us on what progress Premier Inn has made in trying to get more business from the public sector. I think this has been sort of an initiative which you've sort of highlighted in the past. Thank you.
Patrick?
Yeah, we continue to make headway. It is quite slow, but we've seen our government accounts improve, particularly in certain parts where we've got good relationships. We're now listed on their preferred agreement. I think it's about 3.5 to 4.5 million this year we'll do with them, but it is quite slow. There's one big account, the MOD, who still actually contract right across the UK, hotel by hotel. So, but we are making headway there.
Okay. Good.
Our big accounts that we talked about before, our 34 top big accounts, that is still going quite strong.